Welcome to Policy on Demand. I'm Lily Kazemi.
And I'm Scott McCandless. It is the week of April 10th, and this is your Monday briefing. The House and Senate will not be in session this week and will return the week of April 17th. When they do, the debt limit and newly released IRS strategic operating plan for spending the $80 billion in Inflation Reduction Act funding will be among the key items for Congress to consider. Lily?
There has been a lot of focus on U.S.-China trade relations. Craig Stromberg joins us to discuss where relations between the two countries stand now and what potential actions companies can consider. Craig, welcome to Policy on Demand.
Thank you for having me back.
Craig, we've been discussing U.S.-China relations for years now, and the conversation is a little bit different every time. Where do things stand right now?
So I was thinking about this right before we came in this morning, and it has been years now. I think this China conversation and trying to explain this to businesses started with the trade war, right? And that was a confusing period. We sort of got through that. I think we are back into a period where things are honestly confusing for U.S. businesses, no matter your size, your sector, or if you're in China or not. I think we know part of this because one of the best mechanisms that we have for this is the survey that is taken every year of U.S. companies in China by the American Chamber of Commerce. But it's not a perfect instrument, but it's a good instrument. And what it told us this year is that for the second year in a row, U.S. companies are very pessimistic about continuing to operate in and expand operations in China. They don't want to leave the market, and they've been very clear about that. But they've stopped investing, they've stopped buying, they've stopped acquiring, they've stopped expanding. And the principal reason why is because of U.S.-China geopolitical tension. So this is the tie between what happens at the geopolitical level and business, is that if you ask them, and the survey does ask them, why, it is because for the third year in a row of this tension between the US and China. And this is manifesting itself in a bunch of different ways. In DC, right, where we are today, DC is united, right? We sit sort of here in the studio equidistant between, the White House and Capitol Hill, and both of those parts are looking increasingly at China the same. And as you have talked about on the show before, there's real bipartisanship that is going on this issue, which is unusual and really striking for how much of it is happening on the China issue. So the fact that DC is united on this means there's going to continue to be more restrictions on what US companies and US businesses can do and might do in the future. So all the protectionism rise that we have seen in the US in the last couple of years, I think companies should expect to see that. And the last thing I'll say is that this very micro decoupling that has been started by the US of the US technology sector from China, we are still seeing that going on. And depending upon what policy decisions are made in DC, we could see that expand in the next year.
So you had mentioned that there's some political agreement here in Washington, D.C., and in fact, there's a select committee on China on Capitol Hill. There's now implementation of the CHIPS Act. So what might the next steps be for the U.S. and for China that businesses need to know about?
So I think one of the things to understand from a business's point of view that doesn't get a lot of attention in the press, if any, is that there is a safety valve on the U.S.-China relationship. And the safety valve is rather unique. It is the safety valve that exists between Xi Jinping and Joe Biden, right? Because these two individuals know one another, they've known one another for decades. They seem to have, from all we can tell being outside, right, an honest and straightforward working relationship. I think they are doing their best back channel to keep things at a low boil. I don't know how successful they are going to be despite that cooperation going forward, because here's sort of what I see happening from each side. So from the US, there's probably still going to be more protectionist measures coming. This means potentially new actions on export controls, much more action potentially on what US companies can invest in China. And if this goes the way that previous protectionist regulations have gone, you could even see somebody, whether it was the White House or Congress or both, asking for the authority to not just limit US investment in China, but potentially undo existing investment in China. And this would probably come as a very unwelcome development for many US businesses. So export controls and the limitations on investment in China are the two things that are sort of could come next from the US side. On the China side, we are not really seeing a reaction to all of these US moves to limit China's rise, to limit what US companies can do. I'm a little surprised by this. I think they are being very careful. They too are reading the American Chamber of Commerce results. They don't want US companies to have an exodus out of China. And at some point, the Chinese government will react to these things. And the place where they will probably start is by tightening or expanding the cyber and data regulations that already exist on US companies that already cost a significant amount of compliance. That is an easy place for them to start without causing too many waves. So I think that is what companies should be prepared for and be having a plan for, because it is something that is undoubtedly coming. I think the last thing that I would say in terms of each side is more about the US than China. You've already started to see the US government go to some foreign companies and some foreign countries and say, we need you to do your part in helping us fill in the blank, contain, limit trade to, limit the technical rise of China. Thus far, you've seen foreign countries go along with this a little. I don't know if we're going to continue to see that over the long run, because it's a lot to ask. But that doesn't mean the US government isn't going to ask. I think they will continue to.
So Craig, what else can we anticipate, and how does this tie into what some have been coining the term friendshoring with our trading partners like the EU and Japan? And by the way, in your response, can you explain the meaning of that term?
I'm glad we're getting the chance to define this, because it's one of the questions that, sort of depends on where you sit is how you define it, and a lot of businesses ask. Sort of how we look at this is that this conversation began independent of China to a degree during COVID, right? When the US wasn't able to necessarily procure all of the healthcare goods that it wanted to in the sort of time frame that it did. And there was some thought, maybe we should bring some of those things back. That is carried over to this US-China tension conversation and the potential decoupling conversation. So what it really means is, can US companies potentially leave manufacturing in China and go someplace that is either more proximate to the US, like Mexico, Canada, or the US itself, or to places where there are close partnering trade relationships with the US, like Europe, like Japan, like Korea, like Australia. And in terms of, I think, what comes next, I think you are going to continue to hear Washington try and encourage this. This is a very difficult trick for DC to pull off, because one of the ways that the US government is doing this is not that dissimilar from what China does, which it is paying, in the current atmosphere, a significant amount of federal investment to the private sector to jumpstart, right, certain parts of the technology, especially supply chain, that have traditionally been overseas, and get those things done here. This is a native good, but it is causing some reaction globally that they feel that this might be an artificial construct in the economy. So I think you're going to continue to see DC calling for friendshoring and wanting more US production, but I don't know that it's going to necessarily be well received everywhere.
Thank you, Craig. That was a really helpful snapshot and really helpful explanation of the lingo.
Thank you for having me back.
Thank you for being here. Be sure to check out the latest Week in Review with Todd Metcalf and a special episode on the new Clean Vehicles Tax Credit guidance included in the description of this episode. Also, stay tuned for a coming Policy on Demand discussion on the IRS's Strategic Operating Plan and this Friday's Week in Review.
As always, thank you for spending this time with us. Have a great week, and we'll see you next time.